Hi everyone, this is Matt Curfman from Richmond Brothers here with an August edition of Matt's Minutes. Thank you so much for tuning in. I'm going to try to keep this video fairly short as we wind down the summer and not bore you too much with economic data, but I do have some important pieces of information I thought worth sharing as we head into the month of September. And we've got a little guest visiting us today. Can you see my little puppy there? He is laying in the sun in his dog bed. He's not terribly interested in what I have to say, but I hope you are. His name is Parker, and he is a golden doodle, and all he cares about is getting walks and getting pets and getting lots of treats and love from me. If only life could be that simple. So as we head into the fall here, I did some math, and I've been talking to you about the last 2 years from June 30th of 21 all the way up until the end of August of 23. So 2 years and 2 months. And just to kind of give you some data, if you look at broad benchmarks to get an idea of the environment, the NASDAQ during that time was negative 3.2%. The Dow Jones was positive 0.6%, and the S&P was positive 4.8%. If you average those three broad stock market indices for the last 2 years and 2 months, 26 months total, they average less than 1%. If you then go say, well, if I were safe and then bonds, what did bonds do? The Bloomberg US aggregate bond benchmark actually was down 11.7% during that 26-month period. So I bring this up just for context. So it feels like year to date, things are getting a little bit better. Some of the extreme things that when we started the year 2023 that seemed to be pretty negative and pessimistic, such as surging inflation, rising interest rates from the Fed, which translates into higher mortgage rates, higher debt rates, and that basically makes things more expensive. We had also just come off of 2022 with a pretty beaten up both stock and bond market. So investors were feeling pretty exhausted from that downtrend and downswing. And we also had an inverted yield curve. And what that usually means is long-term rates are less than short-term rates. Most times in history, when you have an inverted yield curve, that's typically a predicator to an eventual recession. So over the weekend, I read an article. There was a lot of thought coming into 2023 that sometime in the 2023 year, we could see a recession. Goldman Sachs just recently released an updated research report over the weekend and this morning. And in it, they lowered their odds of recession in the next 12-month period down to a 15% likelihood. It was at a 20% mark before. And these are 12-month forecasts. And they basically said we could see the economy still slow down a little bit in the fourth quarter, but very low odds of a recession, according to Goldman Sachs. There's always that possibility. There's always the possibility of a black swan event, something that we can't control, something that isn't an economic or business cycle. But when you look at the data, that was actually very encouraging to hear because the word recession is still on our minds. So with all of that said, there is some optimism possibly heading into the fourth quarter. Whether that means, stocks and bonds start growing in a straight line, we sincerely doubt that. But there is room for hope and for potentially positive outcomes. So we would certainly welcome just some positive numbers in markets and stocks and bonds as we wind down the 2023 year and kind of move forward. That said, we do think it's real important still to have some cautious optimism. So having some risk one assets really safe, really good downside protectors. Even for those of you who have utilized some of the smoother ride options through Fidelity, on a forward basis, those also add some protections with trailing stop losses on some of the funds. So if there were something really extreme negative to happen, it doesn't completely stop downside, but it largely mitigates it and adds some safety nets or soft landing, so to speak. So if you haven't already checked those out, please let us know. We'd be happy to put together a proposal to review if it could make sense for your specific situation. Remember, smoother ride is the beacon strategy. We use it on Fidelity accounts, and we overlay that by implementing it with Vanguard exchange traded funds. So if you have a lot of Vanguard funds already in your portfolio at Fidelity, you may already be using the beacon strategies. If not, and you're curious, please just email us questions@richmondbrothers.com, and your advisory team would be happy to put together a short proposal just to get you the information and see if it could make sense based on your risk tolerance and your risk profile. The goal of these videos is to educate, to inform, and our aim is to help guide you no matter what is going on in the world. We hope you have a great start to September, a great start to the fall, and we are grateful for the opportunity to work for you and to serve you. If this is helpful, please feel free to share this message with others. Thank you so much for tuning in, and I look forward to connecting soon.